Welcome back to Gold Rush Reporter, your go-to channel for gold and silver analysis. If you're serious about understanding precious metals and what's really happening behind the markets, you're in the right place. Today, we're diving deep into the recent price moves in gold and silver, and why a short-term drop doesn't mean the pressure on the physical markets has eased. Make sure you hit that like button and subscribe, because the insights you'll get here aren't what most people are seeing. Over the past 2 to 3 weeks, we've seen gold and silver prices drop slightly. Some might think this relieves pressure in the market, especially coming out of London, but the reality is more complicated. There's still backwardation in silver, meaning short-term delivery contracts cost more than future contracts, which shouldn't happen in a normal market. It's a clear sign that physical silver is tight. Gold hasn't experienced the same backwardation, but that doesn't mean supply is abundant. The elite, bullion banks and central banks are handling gold very differently. They know gold prices are rising. Evidence? The recent LBMA yearly meeting, where members, bullion banks, refiners, and traders were asked what they expect gold and silver prices to be in 2026. The average answer? Just under $5,000 for gold. That's not speculation from blogs or YouTube hype. That's from the heart of the system. Earlier this year, trucks were seen outside the Bank of England, moving gold to COMEX in New York. That might sound normal, but it's a major signal. Much of the gold in the Bank of England is owned by central banks, and a large portion is leased. Banks rent out gold to earn small returns, often through book entries, meaning the physical gold doesn't leave the vaults. But the visual of trucks moving gold shows that leased gold can actually be moved, and that creates risk. Central banks now understand that renting gold isn't risk-free anymore. This is crucial because the London market depends heavily on these leases for liquidity. Gold and silver aren't just numbers on a screen. The physical availability is what drives real market stability. For silver, the problem is even more pronounced. Around 80% of silver in London LBMA vaults is tied to ETFs, leaving only 20% for industrial use and daily trading. If ETF demand rises or industrial buyers increase orders, the market will feel a serious squeeze. So far, recent price drops may feel like relief, but the structural pressure hasn't gone anywhere. Physical stock levels are still low, and backwardation in silver proves it. Gold may appear stable, but the underlying stress in the system is real, controlled by banks and the LBMA. I want to know what you think. Do you believe the recent drop in gold and silver prices signals real relief, or is it just hiding the bigger problem? Comment below. I'll be reading and responding to your insights. As we continue, it's important to understand how the leasing system and hypothecation affect gold and silver availability. Historically, central banks and bullion banks have rented gold to earn small returns, often 1 to 1.25% annually. On paper, this looks like a safe way to make money, and the gold itself doesn't leave the vault. It's just recorded on someone else's books. But when physical delivery becomes necessary, like the trucks moving gold from the Bank of England earlier this year, the risk becomes very real. Suddenly, the leased gold isn't guaranteed to be where it's supposed to be, and liquidity stress shows up. That's why even if prices drop temporarily, it doesn't solve the fundamental shortage in the physical market. For silver, the situation is even tighter. Silver is used in both industry and investment, unlike gold, which is primarily held as money or a store of value. About 80% of silver in London's LBMA vaults is held by ETFs, and only 20% is left for industrial clients and daily trading. If ETF inflows increase or industrial demand spikes, the vaults could empty quickly, creating a major squeeze. We saw this in 2020, when retail and institutional investors flooded ETFs. The LBMA had to scramble to secure physical silver from anywhere available. The difference now is that the market is smaller, physical supply is tighter, and the potential impact of increased buying is much greater. The recent drop in prices might give casual investors a sense of relief, but the structural problems remain. Backwardation in silver continues, signaling that the nearest term contracts are more expensive than future contracts, something that shouldn't happen in a healthy market. Gold hasn't shown the same backwardation, but that's because the elite and bullion banks manage expectations carefully. They've built a system where gold appears stable, while the underlying physical scarcity is masked. When central banks and market insiders quietly acknowledge that gold may hit $5,000 in 2026, it's not optimism. It's recognition of stress in the market that ordinary investors don't see. Meanwhile, China's approach to silver has shifted. In the past, they held back large amounts to control prices, sending hundreds of millions of ounces west in 2023 to financial hubs like London, Hong Kong, and Singapore. That flow has slowed, and the silver stored in Shanghai futures exchange vaults has dropped significantly. Analysts warn that once total stocks dip below 500 million ounces, supply constraints will become critical. As Asian markets open, we've noticed that gold and silver often move higher during Hong Kong and Shanghai trading hours. This is no coincidence. Asia is taking a more active role in setting physical prices, while Western paper markets are reacting, not leading. Even with minor price fluctuations, the core issue of scarcity hasn't changed. Vaults remain tight, old accounts are unallocated, and lease obligations cannot always be rolled over. The paper price might drop $2 or $3, giving the illusion of stability, but the underlying market pressure is building. The London system's depth is an illusion created by layers of leases, rehypothecation, and derivatives, while the physical core is thin. As the system strains under increasing demand, we are starting to see early signs of stress in premiums for silver coins and bars. This is the beginning of what could become a much larger movement in precious metals markets. Looking deeper into the current gold and silver situation, the London system has reached a point where appearances are maintained at the expense of reality. The large banks, LBMA members, and central banks have developed sophisticated ways to control perception while physical shortages persist. When ETFs and other investment funds buy silver, they draw down vault stocks, increasing stress on the system. Even small inflows can trigger noticeable premiums on physical bars and coins. This is not about greed. This is a clear signal that supply is tight, and the system can't instantly generate more metal to meet rising demand. On the gold side, central banks and bullion banks are more adept at managing public expectations. While physical gold remains scarce, it rarely experiences the visible backwardation seen in silver. This is largely because gold serves as a political and financial tool, and the system relies on careful messaging to maintain trust. When insiders at the LBMA predict a $5,000 price for gold in 2026, it's an acknowledgement of the pressure on physical supply rather than speculative optimism. These projections show that even those who benefit from the current system understand that demand exceeds the available metal in the long term. Meanwhile, the Chinese approach to silver continues to influence global supply. Historically, China has stockpiled silver to stabilize prices, sending large amounts to financial hubs in the West. Recently, that flow has slowed, and silver stocks in the Shanghai futures exchange vaults have fallen sharply. The combination of restricted Chinese supply and continued industrial and ETF demand makes silver particularly vulnerable. Just a small increase in buying could push premiums higher and create real physical shortages. Unlike gold, silver has significant industrial usage, meaning shortages are more likely to translate into immediate price volatility. The difference between paper markets and physical markets is becoming increasingly clear. Paper contracts, futures, and derivatives can only mimic supply. They cannot create actual ounces. ETFs, forwards, and unallocated accounts may give the illusion of liquidity, But the moment investors demand physical delivery, stress appears. This structural imbalance is why minor price corrections don't alleviate the real pressure. Temporary dips in gold or silver prices may calm traders for a day or two, but the fundamental scarcity remains. The system is fragile, and the physical market has far less depth than most investors realize. Another critical factor is how Asia is now influencing price discovery. Traditionally, London and New York dictated the gold and silver markets, but trading hubs in Shanghai, Singapore, and Dubai are taking a more active role. Physical buyers in Asia are increasingly setting the tone for global prices, while Western markets react. This shift in market influence has already created noticeable effects on trading patterns, such as higher prices during Asian trading hours. It also underscores the global nature of the supply problem. Scarcity is no longer just a Western concern. It's a worldwide issue that will impact all major markets. Looking forward, the structure of leasing, rehypothecation, and unallocated accounts means that physical scarcity will continue to be hidden until a critical moment. Investors who ignore this are taking a huge risk, as paper holdings may not translate into actual metal. As we've seen in past silver squeezes, when multiple parties try to claim physical delivery simultaneously, premiums spike and prices diverge sharply from paper valuations. The markets are quietly moving toward another such moment, and those paying attention now may be in a better position to act when the system reaches its breaking point. The strain on both gold and silver is becoming increasingly visible, even if superficial price movements suggest otherwise. Gold's apparent stability is misleading. The real pressure lies in unallocated accounts, short leases, and physical scarcity. The London and New York paper markets can maintain a calm facade, but physical metal is moving differently. Trucks outside the Bank of England earlier this year were a stark reminder that gold can leave vaults rapidly, turning previously low-risk leased metal into a real-time liquidity issue. When central banks and bullion banks see leased gold leaving for actual delivery, it forces a re-evaluation of risk, creating tighter control over remaining stocks. Silver, in contrast, is much more fragile. With roughly 80% of London vault stocks held in ETFs and the remaining in industrial and bullion hands, any surge in demand quickly strains the system. Unlike gold, which is largely a financial asset, silver has significant industrial usage in electronics, solar panels, and other technologies. This dual role makes shortages not just a financial concern, but also an operational one for industries dependent on silver. Even a small uptick in investor demand can trigger a chain reaction, pushing premiums on physical bars and coins to record levels. This is why minor price dips over the past few weeks do not resolve underlying structural issues. They simply mask the problem temporarily. Asia's growing influence on precious metals is reshaping global price dynamics. Physical buyers in Shanghai, Singapore, and Dubai are now setting market tones, and Western traders are reacting. This shift emphasizes that scarcity is global, not localized. While paper markets in London and New York may appear liquid, actual supply is far tighter than public perception suggests. Rising demand from industrial users, ETFs, and individual investors could soon overwhelm existing stocks, leading to a divergence between paper prices and physical premiums. The current calm in prices is therefore deceptive. It hides mounting tension in the system. The LBMA's yearly meeting highlighted just how aware insiders are of these supply stresses. Forecasts of nearly $5,000 gold in 2026 reflect more than optimism. They are grounded in the recognition of limited physical availability and growing global demand. Central banks, bullion banks, and refiners are no longer just observing. They are adjusting strategies to manage risk. Gold is being treated as a geopolitical and financial tool, while silver, with its industrial importance, faces pressures that could trigger dramatic price swings with relatively small inflows of new money. What's becoming clear is that the old Western-led pricing system is losing its dominance. Supply, not paper contracts, is increasingly determining market behavior, with vaults in Asia holding significant stocks and setting transactional prices. Traditional Western hedging and leasing methods are less effective. As the structural pressure mounts, physical shortages will become undeniable, and market forces will respond accordingly. Investors and analysts must focus on actual metal flows rather than chart-based signals or short-term dips to understand the trajectory of gold and silver prices. Looking at the broader picture, the system's fragility means that even modest increases in demand, whether from ETFs, industrial users, or private buyers, can have outsized effects. The divergence between paper and physical markets will grow until the discrepancy forces a major recalibration. Gold may continue to move steadily due to central bank management, but silver's limited supply and industrial demand make it far more sensitive. Anyone ignoring these realities risks being caught off guard when premiums spike and liquidity tightens. Understanding these dynamics is critical for anyone serious about precious metals investing in the current environment. As we look ahead, the trajectory for gold and silver is clear. Structural pressures are mounting, and physical scarcity is shaping market realities more than short-term price movements ever could. The past few weeks' dips may feel like relief, but they're only temporary pauses in a system under stress. For gold, central banks and bullion banks are managing expectations carefully, ensuring prices reflect stability while hiding the true shortage behind leases and unallocated accounts. Silver, on the other hand, is far more volatile. Its dual role as an industrial metal and financial asset means that even small surges in demand, whether from ETFs, industrial consumers, or retail investors, can trigger sharp premiums and market swings. We are witnessing the early stages of a supply squeeze that could fundamentally reshape how precious metals are traded globally. Asia's growing influence cannot be overstated. Markets in Shanghai, Singapore, and Dubai are now physically determining prices, leaving Western paper systems as reactive rather than proactive players. The old model of gold and silver pricing through London and New York is slowly losing authority, replaced by real-time physical flows and supply-demand dynamics. Investors who rely solely on charts or short-term price corrections are missing the bigger picture. Physical scarcity, geopolitical shifts, and industrial demand are now the primary drivers. Understanding this is crucial for anyone serious about navigating the precious metals market in the coming years. For silver specifically, the implications are profound. With ETFs already absorbing large portions of remaining stock and industrial demand continuing to grow, premiums on coins and bars are rising. This isn't speculation, it's a sign that the paper market is increasingly disconnected from physical reality. When demand spikes further, the paper market will have no choice but to follow physical constraints, and prices could experience significant upward moves in a short period. Investors need to recognize that cheap prices on charts are misleading if the metal simply isn't available for delivery. For those committed to understanding these dynamics, staying informed is critical. Regular updates, analysis, and alerts can make the difference between being caught off guard and making strategic decisions. That's why here at Gold Rush Reporter, we bring you insights not just from price charts, but from real-world market activity, vault movements, and the subtle shifts in global metal flows. Our goal is to give you a front row seat to the evolving gold and silver markets, helping you make informed choices before mainstream headlines react. If you found this analysis valuable, don't forget to subscribe and turn on notifications. By joining our community, you'll get early access to market insights, updates on vault movements, and expert commentary on gold and silver trends. Remember, in the world of precious metals, knowledge is your most valuable asset. The market is changing, and those who stay informed will always be ahead. This is Gold Rush Reporter, bringing you clarity in a world of uncertainty, helping you understand where gold and silver are headed next. Stay vigilant, stay informed, and stay ahead.